that's still in the picture of we're still running very large fiscal deficits, which for many industries are a stimulus. So generally what I do is I look at things industry by industry, and I'm trying to determine, is that industry in a recession? Is it priced for a recession? Versus other ones that might be at risk for a recession but not priced for it. So I generally view sector by sector, industry by industry, rather than the whole economic picture.
The American economy is facing a moment of unique vulnerability. On one hand, the stock market is at all-time highs, seemingly unbothered by anything. On the other, a new wave of aggressive tariffs is hitting the US and creating a mild drag on the entire system. The real danger, according to macro strategist Lyn Alden, is the disconnect between these two realities. The market's lack of concern about forward tariff rates is a significant risk, especially since these rates are similar to those that caused a market sell-off just a few months ago. Alden's analysis shows that the over $150 billion in tariff revenue is not being absorbed by foreign exporters, but is instead coming from American consumers and businesses. This friction doesn't affect all sectors equally, as tariff-heavy companies like Ford are more impacted than service sector stocks like Microsoft. This isn't a doomsday scenario, but a gradual deceleration that the market seems to be ignoring. Alden points to yellow flags in the economy, like declining CEO confidence, which could lead to reduced hiring and capital expenditures.
The macro side and there's the venture side. So Ego Death Capital, we just raised $100 million for Fund 2, which deploys in the venture space. So we lead Series A investment rounds, and our focus is on the Bitcoin space. So there's been kind of billions of dollars raised for the broader crypto ecosystem, whereas what we focus on is primarily Bitcoin, to some extent stable coins, and basically things that focus on kind of high utility. And so we still perceive a big market for that. That's why I do on the private side. And then on the public side, my strategy continues to focus on the 3-pillar portfolio. So one pillar is high quality equities, both US and globally. Another pillar is hard monies, so Bitcoin, precious metals, and you can put commodity producers in that bucket, and then a smaller slice of cash equivalents to protect against volatility and to rebalance into any turbulence that can occur along the way. It's never going to be a straight line, but I think we might be past the turning point of them kind of perpetually underperforming US equities in aggregate. I've also been fairly bullish on Chinese equities. But then in the United States, I'm more focused on both growth and value stocks, but ones that tend to focus a little bit more on the service sector. They're generally more protected from tariffs. They're generally more protected from the cyclicality of the economy. And I do think we are at a little bit of a deceleration currently. But whether you look at growth at a reasonable price stocks, including some of the Mag 7, or you look at some of the more value type of equities. So I'm pretty bullish on the financials in the U.S. economy. I think they're relatively well protected from some of the downside scenarios, but they're still inexpensive, unlike some of the highest quality tech stocks that are out there. And so I think there's still a lot of opportunity in equity markets, even though I do think that the top line of the index is kind of stretched at the current time. For the broader side of the portfolio, I think that while I'm still bullish on gold longer term, starting about 3-4 months ago, I got concerned around a consolidation potential. We've been in that consolidation. I think it probably still has room to go. But once we do get to a breakout, I would resume my bullishness on that. And I still continue to be focused on, perhaps not surprisingly, Bitcoin in that hard monies bucket, because while gold is a mature $20 trillion asset, Bitcoin I still think is rapidly growing into the asset that it's going to become. And so as it has exceeded $2 trillion and as it continues to grow and build its network effect and reach corporate and to some degree sovereign adoption, I continue to prioritize that in the portfolio. And cash equivalents, mainly just that's because I'm not bullish on long duration bonds still. I'm not as bearish on them as I was, say, 4 or 5 years ago. But basically, as we, now we're kind of in a period where you get a lot of volatility in them, still not very high yields. And so I use some cash equivalents as a buffer, but it's not an area that I tend to be prioritizing, because the overall backdrop of what I focus on is that because we're in fiscal dominance, things tend to run hotter than a lot of the bears expect. So I've generally been fading some of the arguments to be heavily in cash, even though I don't like to be zero in cash and cash equivalents. So I view that as kind of flat to up. So I don't have a strong view of what happens for the next 6 months because we do have a decelerating economic condition, and so that can put potential downward pressure on the longer end. But I do expect that there's more room for cuts, interest rate cuts, than there is for the long end to really go a lot higher or a lot lower. And so to the extent that we get a steeper yield curve, maybe not over the next 6 months, but over the next 18 months or more, I think it'll be a combination of lower short end interest rates and then kind of flattish longer duration rates would be my base case. So that could be 50 basis points lower, could be a 50 or 100 basis points higher. Depends what happens. Anything can happen in the next 18 months on that end. But I think that'll probably be combined with a somewhat lower on the short end of the curve in response to economic deceleration, as well as because by that point probably would have a new Fed chair that along with the rest of the committee that sets policy would probably have a more dovish bent compared to what we see now. And as far as my bond outlook, to the extent that I want to have some duration, it's still generally in that 2 to 5 year range, less so in that very long term range. That way you can potentially, if you get a 2-year treasury, you can potentially participate in some of the cuts that could happen in the years ahead and lock in more of your yield. But I still think that the attractiveness of the long end of the curve is still not particularly high, despite so much underperformance. And while it's suitable for a trade now and then, I still think that there are much better asset classes out there than the long end of the curve. And one of the things we've seen is that, like when the Fed did mildly trim interest rates before pausing again, mortgage rates and other long duration parts of the curve didn't really go down with it. So there's been a lot of recent political drama about how the Fed should be lower in terms of interest rates, and that argument might have some merit to it. But it's important to keep in mind that just because they lower interest rates, there's no guarantee that the long end would behave accordingly, and in some cases it might even go up. Because if the market perceives that the Fed is not serious about inflation or is too dovish, it could sell off the long end of the curve, including mortgages. And so I still, to the extent that I am in many ways interested in fixed income, I'm more interested in the short end of the curve.
So if the economy is facing this new friction from tariffs, why is Lyn Alden still so bullish on certain assets for the long term? The answer lies in her core thesis: nothing stops this train. This thesis is centered on the US being locked into pretty high structural fiscal deficits due to significant spending on entitlements and defense. While these deficits act as a stimulus for some industries, the combination of higher interest expenses and an aging demographic puts a structural strain on the economy. This dynamic is what makes assets that aren't tied to corporate earnings or subject to these economic frictions uniquely positioned to benefit. This fiscal dominance is a powerful tailwind for assets with scarcity, such as Bitcoin and gold, as they do not have margins to worry about or direct exposure to tariffs.
I generally view the banking sector and to some extent the insurance sector as more of a yield play with some growth attached to it. So some earnings growth, some dividend growth, that if you're willing to take the higher volatility is interesting. There's also, strategy, formerly MicroStrategy, they've been kind of shifting. This ties into banks because they've been somewhat shifting their credit profile. And so they've historically been known for issuing convertible bonds. But their most recent offering is basically almost like a stable coin. We're almost going after the money market, pool of capital. And so they have this new preferred that is intended to trade roughly at a pegged level. They have various mechanisms to maintain it there while paying a yield that exceeds what you get on treasuries currently. They have the ability to adjust the coupons that they pay. They have various mechanisms to kind of maintain that. And so with that, what you get is basically almost like a cash equivalent, but it's backed up by a large pool of Bitcoin. And so I actually find that one of the more interesting introductions, you could say, to the finance sector. And I think that issuance is probably going to get a lot bigger over the next year or so. One of the things I do is that I have a separate slice for energy producers. To the extent that I'm in the energy sector, I've been preferring to play it primarily through the equities, through the producers, because oil has been very range bound. So I've been preferring to buy the assets that are trading at pretty low multiples, that are profitable at current oil prices, that in many cases are paying dividends or buying back shares, and have good balance sheets at current oil prices. And basically what that does is that kind of serves as like a perpetual option on Middle East destabilization or anything else that might drive energy prices higher. And in the meantime, it pays me to own it. And so right now, we're generally seeing that at current oil prices, U.S. shale is kind of gradually stagnating. So there's not a lot of drilling activity. It's not really encouraging a lot of new investment. And of course, there's pretty fast depletion rates in U.S. shale. And so we have this kind of stagnant situation in the U.S. Still kind of tepid demand growth globally, especially with the Fed as tight as they are, and other factors and tariffs and things like that. So a lot of uncertainty. As we kind of look forward a couple years, I generally think that with U.S. shale oil no longer really growing at the pace that the market's become accustomed to, and as we potentially get those Fed cuts, maybe next year, for example, I do think we could see higher energy prices. But then in the meantime, any sort of flare up that is hard to predict in advance, I still like to own it in advance of that. And so in addition to my broader equities portfolio, I have that separate slice of energy so that I basically have some protection, at least against unexpected crises, without trying to overthink it too much. So a couple of things. One, it creates structurally more demand for electrical components, things like converters and various transmission type of equipment. Many of those companies, their backlog extends 3 to 5 years or more. Many of those parts are made in China. And so as kind of AI data center energy usage ramps up, it does put a lot of kind of strain on the grid. And one of the things I emphasize in that article is when people think of AI, they often just immediately also go to robots as though they're kind of functionally equivalent. But anything you do that's portable is way, way harder. And one kind of metric to think about is that the human brain runs on something like 20 watts. It's less than an incandescent light bulb. And only in the past decade have the best supercomputers gotten to a point where they do roughly as many estimated calculations as the brain is estimated to do. And yet they do it on like 20 megawatts of power. So it's like a million-fold difference. Of course, they're way better at some types of processing than the human brain. They're worse than others. But basically trying to take something very powerful in that sense and then putting it into a portable robot that needs to run on, say, kilowatts of power is a very different dynamic. And so I still think that we're far away from portable AI matching humans in many capacities. But certainly in the data center sector, that's where we see basically a lot of AI agents able to do a significant amount of white collar work. And so I do think that over the next several years, there will be ongoing usage there. So that's a big uptick in GPUs, big uptick in electricity production. One of the things I focused on over the past several years is Bitcoin mining, because people had all these fears around Bitcoin mining potentially driving up prices or competing with other things. The funny thing is AI data centers actually do have some of those issues that Bitcoin miners, for the most part, didn't really have. And that's because Bitcoin mining was and is super competitive in the sense that what they mainly compete on is getting the best machines and then getting the lowest electricity prices. And so they really can't compete with like urban electricity prices. They have to go out to the weird places where there's like stranded energy, or they have to buy energy at times of the day where nobody wants it, and then pull back during the more in-demand times. That's just inbuilt to their economics. Whereas AI data centers, because they have a lot more capex than Bitcoin mining, and they also have higher needs for like uptime and lower latency. They generally don't want to shut off the way that Bitcoin miners do. When possible, they want to be close to the population centers, whereas Bitcoin miners don't care as long as they have Starlink or something. And so AI data centers actually can compete with consumer electricity prices and basically drive up electricity prices in U.S. states, in other parts of the world, and so I do think that that will be an issue going forward. I do think it'll result in, on average, more natural gas demand, and potentially close the gap in terms of how much energy per cost you get from natural gas versus oil. And I also think it'll be a long-term demand driver for nuclear as well.
Are we going to see a de-escalation of the trade war is my broader question.
We'll see. My concern right now for the next 2 months, I think we're in a vulnerable window where, like you said, we don't have all the information. There's a lot of uncertainty over the next couple months, and even the recent deals are still pretty high tariff rates compared to pre-April. And so back in April, there were all these tariff proposals, and the market freaked out. So equity sold off. Credit markets freaked out, basically higher spreads. And right now, estimated forward tariff rates are pretty similar to what they were back in April before the de-escalation. And yet the market is at all-time highs. Credit spreads are narrow. There's really little concern. And so my general view is that there's more risk from tariffs than is probably being priced in. And so short of a major reversal, I do think that it'll be an ongoing friction against the U.S. economy, and then particularly tariff-heavy sectors. Most analysis so far, like when you look at import prices, they're not down, and they're measured pre-tariff. And so there's not much sign that foreign exporters are absorbing the cost, which means most of the tariff revenue is coming from some combination of American consumers and American businesses. There's also the fact that because tariffs were telegraphed in advance, many importers front ran the tariff. So they pulled in extra imports in Q1, and that gave them some degree of a buffer against, kind of the U.S. Treasury takes in, I think they reported over 150 billion in tariff revenue. Well, they also, because the importers pulled in a lot of products ahead of time, that gave them some buffer before they have to really kind of pass on costs to consumers. But as if the tariffs do stay in place as they are, I do think that'll increasingly trickle out to consumer prices. And so most of this is at least a mild drag on the U.S. economy that somewhat offsets other things that are stimulating. So we're still running pretty large structural fiscal deficits. Nothing stops this train. That's still the background situation. But then that is, at least around the margin, somewhat offset by these structurally higher tariffs. And most of the deals we see, like we saw the one with Japan, where we place tariffs on them. Certain sectors are more targeted than others. There's generally headlines around, say, big investments that Japan's going to do. But when you dig into the details, mostly it's lending, which in many cases they're already doing. That's generally how this mechanism works, is that the U.S. runs these really big trade deficits with the rest of the world. They take the dollars and then they often buy our assets or deploy their credit into our assets. And so I expect that to continue. But basically, I think that we have this new kind of annualized multi-$100 billion tax that is roughly spread between American consumers and American businesses. Obviously, some sectors are more impacted than others. So we see, for example, Ford talking about the tariffs, but we don't really see Microsoft worried about the tariffs. And the reason that's notable is when you look at, say, the way these companies kind of operate is Microsoft is something like 100 times the market cap of Ford. So when we're talking about investing, we're talking about the stock market, it's all about Microsoft. It's not about Ford. But when we look at the broader economy or socio-political situation, Microsoft doesn't even employ twice as many people as Ford does, despite being 100 times the market cap. And so things that slow them down or impair them, while they might not be as spectacular in the near term on the stock market, they do tend to trickle out quarter by quarter as we see some degree of stagnant economic conditions. So I'm currently in the camp that views gradually decelerating U.S. economic situation. We don't have great seasonality coming up, especially by September in the stock market. So I do think that at least this 2-month window is a time for potential caution until we have maybe a little bit more clarity on what tariffs are going to look like going forward.
And so ultimately, back to my question, how concerned should we be about tariffs?
I would say moderately,
Mhm.
and more so economically than say the service sector stocks. Basically, this is where magnitudes are important. So basically, the fact that they brought in something like 150 billion in tariff revenue has to be compared with the fact that the U.S. is a $30 trillion economy, right? So while that's a non-trivial amount, it's not as though that's going to shut down the economy. In addition, some of that was buffered by the front running I mentioned, where companies were able to kind of pull in stuff ahead of time. So even as new purchases are coming with tariffs, they generally had inventory that they could still sell at prior prices. So I do expect to see some ongoing consumer price pressures from this. I'll be watching purchasing like import prices pretty closely to see to what extent, if any, foreign exporters are absorbing it. So far, not much. When we look at the recent GDP print, one of the things that complicates this is that tariff front running adds noise to the GDP figures. So if you remember, Q1 GDP was reported pretty weak. And that was negatively impacted by a lot of that import front running, because when you have a big uptick in imports, that puts downward pressure on GDP. And because we kind of have the hangover from that, where there's like less importing now, that's actually good for Q2 GDP. When you look at final domestic sales, the portion of GDP, that was markedly decelerating in Q2. It wasn't a catastrophic print, but it wasn't a very strong print. Also, if you look at CEO confidence, it's been down significantly recently, which is not great generally for CapEx and hiring. And so overall, I wouldn't say there's massive red flags in the economy, but there's certain yellow flags. I've generally been in the pretty bullish camp through 2023 and 2024. And here in 2025 is kind of the first time in a while that I do have more concerns overall around both the state of the U.S. economy and stock markets.
In conclusion, Lyn Alden's analysis offers a crucial counter-narrative to the market's current complacency. While tariffs are creating a near-term mild drag, the deeper, more powerful force at play is the US's persistent fiscal deficits. This dynamic is what makes scarce, resilient assets like Bitcoin and gold so compelling for the long term. This isn't a traditional bull market. It's an evolving, institutional phase defined by stair-step growth and consolidations. According to Alden, the cycle isn't over, and this consolidation phase may simply be the calm before another breakout. It's a reminder that in an economy facing fundamental shifts, a diversified portfolio that includes these hard money assets is more important than ever. We want to hear your thoughts on this. Do you agree with Alden's outlook? Leave a comment below. Don't forget to subscribe to CryptoFlix for more honest and insightful content.